Hi, welcome back. As a precursor to talking about how valuation and pricing can shift across the life cycle, I want to lay the foundations for how to value a company or to price it and what the contrast between the two are. Let's start with intrinsic valuation 101, the absolute basics. While we can dress up intrinsic value and make it sound more complex than it needs to be, ultimately the intrinsic value of an asset or a business is a present value equation. It's the present value of the expected cash flows you will make by investing in that business. So you look at the ingredients, you need expected cash flows. Key is expected in the future, not cash flows in the past, but cash flows in the future. And you discount those cash flows back at a risk-adjusted discount rate. That is intrinsic valuation. Now, of course, in the context of valuing a company, you have a choice. When you're asked to value a company, you can either value just the equity in the company or value the entire company. You're saying, what's the difference? When you're valuing just the equity in the company, you're looking at cash flows to just the equity investors, which is the cash flows left over after interest payments, after debt payments, cash flows to equity. And you discount them back at the rate of return that equity investors demand, the cost of equity. Cash flows to equity, discount the cost of equity is the value of equity. In fact, in its most stringent form, you can argue that the only cash flow you get as an equity investor in a publicly traded company is dividends, and discounting dividends back today is essentially the oldest intrinsic valuation model around is an equity valuation model. Here's the alternative. Rather than focusing on just cash flows to equity, why not look at cash flows to both equity and to debt? Remember, lenders get cash flows from the firm as well in the form of interest payments and principal payments. The collective cash flow to both equity and debt is called the cash flow to the firm. It's a pre-debt cash flow. It's after taxes and after reinvestment before debt. You take those cash flows, you discount them back, not at the cost of equity, because now you look at the entire firm, but at a weighted average of the cost of equity and the cost of debt. Sound familiar? That's the cost of capital. Cash flows the firm, discount the cost of capital, gives you the value of the entire business. Which one's right? Either should give you the same answer for equity if you do it right. So the key is to pick one and to stay consistent. Either value the equity, be equity focused, or value the entire business. Now, often when we think about valuation, we think about taking the present value of the cash flows over the life of an asset. So if you have an asset that lasts 10 years, you estimate the expected cash flows in the next 10 years, you discount them back to today, you come up with the value of the asset. When you value publicly traded companies, here's the challenge you face. At least in theory, a publicly traded company can keep going and going forever. There is no finite end date. So to value a publicly traded company, again, at least in theory, you got to estimate expected cash flows forever. Nobody can do that. We're looking for closure, and here's the way we get closure. We assume that at some point in time in the future, your cash flows will start to grow at a constant rate forever. You're saying, what does that buy me? It buys you an infinite series in mathematics, and 200 years ago, mathematicians solved for the value of that series. We've stolen that in valuation, and you will see this show up in an intrinsic value model in what's called the terminal value. The terminal value is the present value of the cash flows beyond the year in which you compute the terminal value forever. So the value of a business then becomes the value of the expected cash flows during this finite growth period and the present value of the terminal value you will get at the end of that growth period. Ultimately, though, if you're doing valuation of a business, the drivers of value are just fourfold. The first is, what are the cash flows you're getting from your existing investments as a company? Presumably, you can get some of the answer to that question by looking at existing financial statements and what the company has on the ground. The second question you got to ask and answer is, what is the value that you're going to add or destroy by your trying to grow in the future? Growth by itself is a double-edged sword. The good side of growth is it makes your revenues and earnings larger. The bad side of growth is you got to reinvest to deliver that growth. Build factories, invest in R&D. You can already see why the net effect of growth can be negative. If what you're reinvesting is less than what you get as upside from higher growth, growth can destroy value. If what you reinvest is less than what you get as upside, growth can increase value. Third question is, how risky are your cash flows? Because ultimately, The same expected cash flows will be worth less if there's more uncertainty, risk associated with them. And finally, to get that closure, when will your firm be a mature firm? You're saying, what's a mature firm? A mature firm is one that grows at a rate that is less than or equal to the growth rate of the economy. You know why we need that, right? Because to assume that you can put closure, you have to assume cash flows grow at a constant rate forever. That growth rate has to be, by definition, less than the growth rate of the economy, because if it's not, you have a math problem. Your company will become bigger than the economy. What are your cash flows from existing assets? What's the value that's added or destroyed by growth? How risky are you as a company? When will you be a mature company? Another way of framing this is to think of the traditional discounted cash flow model, because the answers to the 4 questions that are laid out are all in that model. What are your cash flows from existing assets becomes your starting point, the base year numbers. What's the value of growth shows up in the growth rate you use and the reinvestment that accompanies that growth. When will you become a mature company becomes that point in time in which you compute the terminal value. And how risky are you as a company shows up in your discount rate. When I look at discounted cash flow models, I'm effectively looking at the answers to the 4 questions in the previous page. When I do valuation, I believe that valuations have become far too complex. I believe in parsimony. Most non-financial service companies that I value are built around 5 inputs. Let me go through the 5. 3 give me my expected cash flows, and I'm trying to value the business, not the equity. These are the 3 inputs that drive my expected cash flows. The first is revenue growth. What does that capture? It captures the growth part of my story. Revenues are a much more honest metric to focus on because you can't play games with revenues. You got to grow the number of units you sell or charge a higher price. So revenue growth is the growth part of my story. But revenue growth by itself just makes my small revenues to big revenues. For me to be valuable, I've got to make earnings that reflect those revenues. So the second input that I'm going to look at is my operating margins. Again, I would love to have high margins, but it's going to be constrained by what kind of business I'm in. So the second driver, and this is my profitability part of my business model, is captured in the operating margin. So revenue growth captures the growth part of my story. The operating margin captures the profitability part of my story. But remember, growth requires reinvestment. My third input captures how efficiently I deliver that growth. What am I reinvesting to get that growth? Revenue growth, margins, reinvestment capture my cash flows. Now, the other inputs I need are risk inputs, and I have 2 sets of risk inputs. One captures the risk in my operations, which I capture through a risk-adjusted discount rate, a cost to capital, which is a weighted average of my cost of equity and cost of debt. That captures my operating risk. But there's a second risk. Remember, we talked about failure risk, especially high at early stage in the life cycle and very late in the life cycle. That's almost impossible to bring into a traditional intrinsic valuation structure. You can't hike up discount rates. You can't lower cash flows. You have to bring it in as an explicit failure risk and play through what happens to your equity if that happens. So failure risk captures the chance my company will not make it. So revenue growth, margins, and reinvestment give me my cash flows. The risk shows up in my cost of capital and my failure risk. And I'm going to argue that this structure, simplistic though it might be, allows me to value pretty much any non-financial service company, young or old. Now, one of the things I've learned in my years teaching valuation is a valuation is never just about the numbers. A good valuation is a bridge between stories and numbers. You say, what are you talking about? When I show you the value of a company and I give you my projected numbers, rather than focus on the numbers, you have to look at the story that drives those numbers. So when I tell you a company has revenues of $5 billion 10 years from now, the question you got to ask me is, what is the story that you're telling me about this company that explains those revenues? In a good valuation, every number you see in your valuation has to have a story attached to it. And every story you tell me about a company has to have a number that goes with it. Good valuations are bridges between stories and numbers. Now, how much of a balance you have between stories and numbers will vary across companies and partly be affected by where that company is in the life cycle. But without a story, all you have are numbers in an Excel spreadsheet. Without numbers, all you have is a fairy tale. It's that connection that allows you to come up with a good valuation. One of my concerns with what's happened in valuation over the last 4 decades is we've encouraged tribalism. There are people who are very good with numbers, who hang out with other people who are very good with numbers. They're all numbers people. And there's not a story person in the mix. And when you do that, your delusion is, when in doubt, add a decimal. Everything is driven by the numbers. Conversely, you have other groups that are all storytellers who tell each other bigger and bigger stories. But unconstrained stories, as I said, are fairy tales. Connecting the two is what creates a good valuation. Now, when you think about that lead-in, I want to argue that when you tell me a story about a company, how big or how small is up to you. My job is to figure out the valuation input that is affected by this story. And that's where having a parsimonious approach to valuation helps you. Because when you have a parsimonious approach, I know where it shows up in my valuation. So let's suppose your story is about a company that is approaching a really big market, geographically like China, in terms of business like AI. My job is to show it in the market you're going after, the total market. If your story is about how your company is going to dominate its market, have a high market, be able to capture a large share of that market, my input that will reflect that is your market share. If your story is about how strong and sustainable the competitive advantages your company has, the input that's going to reflect it is the margins. If your story is about how your company is going to be able to get tax breaks because it's close to the government, it's going to be in the taxes part of the story. If your story is about how your company can scale up quickly because it is very, very light on capital, it's an intermediary, the place it's going to show up is in the reinvestment that accompanies my growth. If your story is about low risk, it's in a low discount rate and low failure risk. Every story you tell has a place in my numbers, and the advantage of having a parsimonious valuation model, it's easy to make this connection. And here's where I want to talk a little bit about how valuation shifts across the life cycle. Everything I said about valuation applies to any company wherever it is in the life cycle. But here's where you might see variance. This notion that intrinsic value is stable and fixed is a myth. Intrinsic value will shift over time and shift more with young companies and with older companies. Second, when you write out the intrinsic valuation of a company as a function of its expected cash flows and its risk, you should expect to see a very different pattern of cash flows for young companies and older companies. And think of what? When you try to value a young company and you project out the expected cash flows, early in the time frame, your cash flows will be negative. It's a feature, not a bug. They'll be negative because you're often losing money or reinvesting huge amounts. So when you value young companies, you expect to see negative cash flows up front. And if your company is a healthy one, those cash flows will eventually turn positive. And your terminal value will be a large positive number. If you're valuing a mature company, your cash flows are more likely to be positive right from the beginning, but with much lower growth. So what you should expect to see as your cash flow patterns will vary across the life cycle. Finally, we talked about getting closure from the terminal value. There are people who estimate how much of their intrinsic value comes from the terminal value. And they have rules of thumb. It shouldn't be more than 75%. Get rid of those rules of thumb. When you're valuing a young company, remember its cash flows are often negative up front and its terminal value is nirvana. Don't be surprised to get 90, 95, even 120% of your value coming from the intrinsic value. If that strikes you as strange, that's the way you make money on high growth companies. It's not with the cash flows you collect while you hold it, but from the price you will get when you sell it. Young companies will be much more dependent on that terminal value for their intrinsic value today than more mature companies. So as you look at valuation, well, the mechanics may be the same. The process you go through might be the same. The numbers you look at, the cash flow effects will vary. And here's the other dimension on which you might see differences depending on where a company is in the life cycle. Remember I said evaluation is a bridge between stories and numbers. Early in the life cycle, if you look at where your valuation is coming from, it's coming primarily from the story. Why? There are no numbers on the ground. There is no history to look at. So early, when you value young companies, it's the story that drives your valuation. And how much of a value you get will depend on how big the story is. And when you look across investors, you expect to see big differences in value across investors because you're each telling stories and you're telling very different stories. As companies age, the numbers start to come into play. You're valuing Coca-Cola. The numbers might drive your story rather than the other way around. You're more number constrained, and the differences you will see across investors will narrow because you have now far more that you agree on that's already on the ground. You should expect to see a lot more storytelling with young companies, a lot more number-driven valuation with mature companies. And the drivers of value are going to shift as you go through the life cycle as well, from how big the narrative is to how much you can scale it up to how sustainable it is. And finally, differences across investors are also going to shift depending on where in the life cycle. So that's the intrinsic valuation part. Let's talk a little bit about pricing. To understand the contrast between value and pricing, let me show you a picture that I'm very fond of. It shows you the drivers of value and the drivers of price. We know what drives value, and you saw that already. It's cash flows, growth, and risk, and we use intrinsic valuation to make that judgment. You know what drives price? It's demand and supply. You're saying, aren't demand and supply driven by cash flows, growth, and risk? Partially. But we also know that demand and supply are driven by mood and momentum, which effectively means that you have a pricing process that can give you a price that's often very different from the value process. And if you look at the tools we use to price things, we try to, essentially compare what we're pricing to other things like it and see what other people are paying for similar things. Whenever you see people use multiples and they claim to be doing valuation, that's not true. They're pricing companies. Nothing wrong with it. A very different process. The value process driven by cash flows, growth, and risk gives you value. The pricing process driven by demand and supply and more indirectly by mood and momentum gives you price. And sometimes the two can give you different numbers. That's at the basis of active investing. With that lead in though, let's think about what drives pricing. Of course, you have all the fundamentals, but here are the other forces that can drive pricing. The first, as I said, is mood and momentum. Big forces. Behavioral finance has laid out all these human, I won't call them irrationalities because that suggests that they will go away. They're part of our genetic makeup that can drive the pricing. Liquidity is a big factor in pricing. You can see, in liquid markets, price can increase, market liquidity disappears, price will drop. Pricing is also driven by what I call incremental information. What is incremental information? Small pieces of news about a company. A 3% beat of an earnings expectation will cause a 20% jump in the pricing. And finally, pricing by its very nature, you're looking for a crowd to join in with. Other people are buying when you're buying. Other people are selling. There's a lot of groupthink involved in pricing. Put simply, the drivers of price can be very different from the drivers of value. So when you're asked to price something, being asked to do something very different than when you're asked to value the same thing. So let's say you're asked to price a stock. Let's go through the process of pricing a company or an equity. The first thing to recognize when you're pricing a stock, you can't compare stock prices across companies because the price per share is in a sense arbitrary. What I mean by that is if I take a company like Nvidia, it was trading at 1100 just a few months ago and it's now trading at 110. It sounds like a big drop off in price, but it's really not because it did a 10-for-1 stock split. The number of shares multiplied tenfold. So what do? Rather than compare price per share, we standardize the price. Sounds fancy, but standardizing the price basically means scaling the price to something. So let's look at the choices because that's what you get with the multiple, a price earnings ratio, an EV to EBITDA. Let's look at the numerator. The numerator of the multiple is usually a market number, market price of equity, market cap. It can be market price of equity plus debt, which is market value of the firm, or market value of equity plus debt minus cash, which is called enterprise value. All three are measures of what the market price of a company is. What can you scale it to? You can scale it to revenues. Why would you use revenues? Because you're desperate. Everything else is negative. You can scale it to earnings. Earnings can be to equity investors, net income. It can be to all investors, operating income. It can be to cash flow. To equity, that's net income plus depreciation. But if you're looking at the entire firm, it can be operating income plus depreciation, EBITDA. It can be to book value. After all, that's what the accountants claim your company is worth, either book value of equity or book value of the entire firm, or book value of invested capital, which nets out debt. Numerator is always a market number. The denominator is something you scale that market number to. Every pricing ratio you see out there is just a standardized price. That's step one. Step two, you've got to make some choices on that scalar. What period are you getting that scalar from? Let's take earnings. You can divide the price today by earnings in the most recent fiscal year. You can divide price today by earnings in the last 4 quarters, called trailing earnings. You can divide price today by expected earnings in the next 4 quarters, forward earnings, or earnings in the year 2028 or 5 years from now, which is really, really forward earnings. So you have choices in terms of timing for the scalar. That's part of that first step, is you've standardized the price using some scalar where you've chosen the timing of that scalar. Second step, you try to find comparable companies. It's kind of a reach, right? If I asked you to price Microsoft, you're saying what companies like Microsoft? You might decide to pick other big software companies, but you have to look at, in making that choice of comparable companies, you have to decide whether you want to go narrow and find companies just like yours, or have a much broader brush and come up with more companies. Do you want to look for companies with market caps very much like yours, or are you just going to look at all companies? Are you going to look at companies listed in the same market you're in, US, other US companies, or are you going to go global? You can already see that when people talk about pricing, there are choices that they can make that are subjective, that can give them very different numbers as pricing for the same company at the same point in time. You got a standardized price, you got these comparable companies where you see what other people are pricing those companies at. And then if your company's pricing is different, either much higher than the comparables or much lower, you tell a story about risk or growth or the quality of growth to explain away those differences. That in a nutshell is all of pricing. And you open up an equity research report. That's basically what you're seeing. When a banker comes up with a number for an acquisition, they're pricing the company. This is what you're seeing play out. So let's talk about pricing across the life cycle. Early in the life cycle, you're going to see companies price relative to potential markets. Why? Because you have nothing else. You have no revenues, no earnings, no cash flows. You might divide the price and the market cap of a company by number of subscribers, number of users. You're trying to come up with some scalar. So you're going to see pricing metrics that reflect the fact that you have a very young company. Okay? So it could be total addressable market, number of users, number of subscribers. As companies come into young growth, you're going to see more revenues, but probably forward revenues. Why forward revenues? Because even though you're starting to make revenues, those revenues are small right now, but they can become much bigger in 2 or 3 or 4 years. So you're going to see a lot of revenue multiples using forward revenues. And the peer group is going to be other young companies like yours, which have gone public maybe recently. With high growth companies, you're going to see revenues become much more established and maybe even trailing revenues, because now your revenues are large enough that you can do a multiple of revenues. Why not earnings? Because you still are probably struggling to make money and your margins have not hit steady state. You're still staying revenue focused. Now you're a mature growth company. Your earnings have now caught up with your revenues. You're in steady state in terms of margins. This is when you're going to see earnings multiples, but perhaps with a growth component built in. PEG ratio, you divide the price earnings by the growth rate, or a forward PE. When you look at mature, stable companies, you're going to see far more enterprise value multiples, enterprise value to EBITDA, enterprise value to invested capital. Why? Because with mature, stable companies, debt becomes a wild card. Some companies borrow money, some companies don't borrow money. Difference in debt ratios. When you have different leverage across companies, using equity multiples like price earnings becomes more dangerous. You're going to see more enterprise value multiples. And when you're in decline, you're going to see more book value multiples. Why? Because people, for better or worse, attach book value and associate book value with liquidation value. At each stage, your peer group might differ, but you're going to see pricing kind of evolve as you go through the life cycle. So you tell me where companies in the life cycle, I can probably guess what kind of multiples you're most likely to see with these companies. So both valuation and pricing, the core ideas remain the same. With intrinsic valuation, the value of a company is a function of its cash flows, growth, and risk, no matter where it is in the life cycle. With pricing, you got to standardize the price, find a peer group, and then control for differences. That stays the same across the life cycle. But how you do it and what pricing metric you use can shift depending on where you're in the life cycle. Something to think about as we go into future sessions where we focus in on each of the stages of the life cycle and how you approach valuation and pricing at most. Just as an aside, with young companies, often you will see many people avoiding doing valuation at all and sticking mostly with pricing, and their defense will be too much uncertainty. I mean, I've talked to venture capitalists who've never valued a company. They've always priced companies, and I don't quite buy into that uncertainty argument. Using a multiple of total addressable market or subscribers doesn't make the uncertainty go away. So while at first sight it might look like pricing is better than valuation, you have a lot of uncertainty. It just pushes the uncertainty behind the curtain. I hope you found this session useful, and I thank you very much for listening.